At this point, you're probably already well informed that the month of September is historically the worst month of the year for stocks. And I don't think just because we are turning the calendar to September that stocks are just going to fall. But I have a list of reasons to be concerned about where we're at from an economic standpoint, where we're at from the labor force side of things, where we're at from treasury, gold, and so on. There's a lot of signs in the market pointing towards a pullback. This doesn't necessarily mean we're going to have a recession, and maybe we don't even get much of a pullback. But I'm going to go through the facts and why I believe that a pullback is in store and already beginning for the stock market. So before we go over these reasons, do me a huge favor. Just simply click that like button down below. Show your appreciation. Also, consider subscribing to the channel so you're notified anytime we drop new content, and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is The Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could check out their 10 best stocks to buy right now. All right, let's jump back into our video explaining why I believe a stock market pullback is imminent. Now, I'm no magician and I don't have a magic 8 ball that's going to tell you the day and time of when we, or even if we are going to get this pullback, but I'm going to explain my reasoning on why I believe it is imminent. So let's begin with reason number 1 and just get this one right out of the way and start with seasonality. As I mentioned at the start of this video, September is historically the worst month of the year for stocks. But this shouldn't necessarily be a reason to adjust your portfolio in and of itself. But as you can see here, it's not necessarily something we should ignore because this is data dating back to the 1920s. September, far and away, the worst month for stocks. And as you can see from this chart, no, it's not just the S&P 500. It's market-wide, from the Dow Jones all the way down to the Russell 2000. So why does this happen continuously in September? Well, number 1, it's the first full month in which many money managers are back full-time in the office. A lot of the summertime is done, kids are back in school, and now we're again focusing purely on our portfolios. The second reason is the fact that we are now 8+ months into the year. Money managers need to start thinking about taxes. We have large gains. We have large losses that can help offset some of those gains, also known as tax loss harvesting. Selling winners and selling losers. What do they both have in common? It's more selling than buying. Looking at this chart here though, zoning in on the month of September by day, it's not the early part of September that you need to worry about all that much. It's the back half of the month. Of the last 15 days of that month, on average, nearly 75% of those days have been negative, and this is data dating back to 1950. So all that is something to keep in the back of our minds. And that leads us to reason number 2, which is a weakening job market. When it comes to the economy, it all starts with jobs. If people don't have jobs, people don't make money. If people don't have money, they can't spend as much money. If people can't spend as much money, earnings don't grow. And if earnings don't grow, companies cut jobs to save money. It's a revolving process, and it's part of the consumer. We are a consumer-focused economy. The consumer spending takes up 2/3 of all GDP here in the US. So when it comes to assessing the strength or weakness in the job market, there's really 4 primary ways that you can do this. You can look at the jobs report, which is going to tell you how many jobs were added during a particular month. You can look at the unemployment rate. You can look at jobless claims, and you can also look at the JOLTS report, which is going to explain job openings. Let's begin by taking a look at the latest jobs report for the month of August, which that showed the economy added only 22,000 jobs during the month, well below the 75,000 economists were expecting. And with that reading below 100K, that would be the 4th straight month that we are below 100,000 jobs added, which would be the weakest stretch dating back to the start of the pandemic in 2020. In addition, the unemployment rate also increased to 4.3%. Revisions are also important to look at for prior months, as July had minimal changes, but June actually showed that we had a decrease of 13,000 jobs during that particular month. The data is clearly showing a weakening labor force, but the thing to note is looking at jobs added, looking at the unemployment rate, those are factors that are backwards looking. However, we did also get the ADP report this week, which showed a dramatic job slowing as private payrolls increased by only 54,000, again, well short of the 75,000 estimate. It was also well below the revised July number that showed 106,000 job gains, so a big drop off there. Now let's move to the job openings side of things, which could be more forward-looking, because if businesses are more confident about the economy, at least in the near term, moving forward, then they have no problem hiring folks. But if they start tightening up, it could be a sign that they have some near-term concerns. Let's take a look here at this chart, which I found quite interesting in my research. And again, this speaks to the weakening we are seeing in the labor market. We now have more unemployed Americans than we have open jobs. This is the first time that we have seen this since the pandemic days of April 2021. The thing is we're not really seeing layoffs tick all that much higher here. It's folks that are leaving the workforce and they're struggling getting back in. The last piece of jobs that we're going to take a look at here is going to be jobless claims. We get this on a weekly edition. Now, when it comes to jobs added and the unemployment rate, again, that's backwards looking. Jobless claims is real-time data for the most part. It's just 1 week in arrears. So this is the closest to real-time data we get. The latest jobless claims increased 8,000 to 237,000. However, continuing claims, which I pay a little bit more attention to, actually fell by 4,000 to 1.94 million. However, the jobless claims have kind of been stagnant since 2022, which does give me a little more confidence in the job market. And that's going to lead us to reason number 3, which is going to be the focus on the 10-year Treasury. And again, you have known that this administration has been putting a ton of pressure on the Federal Reserve to lower interest rates. Some of that has to do with refinancing the abundance of debt that we have here in the US. But when it comes to the Federal Reserve, their dual mandate is to maintain maximum employment and also steady monetary policy to ensure inflation doesn't get out of hand. So when it comes to these two things, we have seen inflation come down dramatically. Just a few years ago, we had CPI reports that were well over 9%. Now we're starting to see it creep higher, although it's come down a ton, and we are starting to see the cracks, as we just talked about, within the labor force. The time is now to cut interest rates, and that's going to start taking place this month in September, I believe. However, here's a look at the 10-year Treasury, which is now at its lowest levels we have seen since April, sitting at 4.07%. This here is a clear sign of investors getting concerned about the near term in the stock market. Remember, the bond market is way bigger than the equity market. And when we see investors moving more towards fixed income and maybe moving out of equities, that is a sign of near-term concern. And that leads us to reason number 4, which is going to be gold trading at new record highs. Again, gold, treasuries, these aren't all that exciting of investments, but they're very telling investments. When we see investors moving to these types of things, this tells us as equity investors that there's a lot of folks out there that have some near-term concerns, and there could be trouble on the way. This could be concerns about the economy or just uncertainty ahead. Investors, though, have sent the price of gold to new record highs, and on the year, the price of gold has risen more than 35%, touching a high of $3,600. Record high gold prices, even though I'm invested in gold ETFs, isn't something we like to hear from an investor standpoint. And that's going to lead us to reason number 5, which is going to be increasing service inflation. And when we talk about inflation, the first thing a lot of investors think about is CPI. But that's not the only thing or the highest weighting that I put when I'm assessing inflation. CPI is important to look at. You could look at things like PPI or ISM. The ISM report, that looks particularly at manufacturing or service, which in the latest report we saw, yet another contraction, the 6th consecutive month of contraction. Speaking of PPI, for the month of July, that increased nearly 1% during the month, which was much more than economists were looking for. So here we are, with the stock market trading near record highs, valuations are currently stretched. There's a lot already priced into the market in terms of earnings growth over the next 12 months. We already have priced in that the Fed's going to be cutting interest rates here in the month of September, but there's not a lot of folks that are focusing on what's happening in the economy right now and what's to come. We are seeing cracks in the labor force. We are seeing investors move towards more safe havens, gold at all-time highs, seeing the price of bonds go up, which pushes yield prices a lot higher. We're seeing core inflation for ISM reports and things like that. There's a lot of things building up to be concerned. Now, this doesn't necessarily mean we're going to have some massive sell-off, because if we do in fact get this dip, I'm going to be buying it. But I'm just trying to prepare you as an investor so that you're not surprised. Because anytime we get emotional with our trading, that typically leads to bad decisions for our portfolio. So let me know what you expect in the market for the rest of September. Remember the stats we looked at. It's the back end of September that we should be most concerned about moving forward. Do you think we're going to have a pullback, or do you think in September we will see yet another record high for the S&P 500? Thank you again for watching this video, and in the comments also let me know, what is your idea of these types of videos? Are these things that you like to see from myself? More of a market update in real time. So thanks again for watching. And if you found any value, show your appreciation just by simply clicking that like button down below. I truly appreciate it. And with that being said, we'll see you in the next one. Take care.